Shane, how's it going?
Kyle, I was hoping you weren't going to ask me that today, but you start every call asking me how it's going, and then I have to think about how it's going, and then I don't want to lie. Today is a rough day. But we're gonna get through it. I know you're on vacation for the next couple of days, so we're doing this call a little early, on what's today? It's today, Wednesday, not
Wednesday, March
Thursday.
22nd.
Yeah, so I don't even know what day it is. That's how it's going, man.
Yeah. Well, I know it's my birthday, day older, and so I totally missed the Fed. I'm sure that's something we're going to get into here, but I was actually at a lunch meeting, so I just came out and saw the stock market was up a little bit, but it looks like it gave that back, and gold was rallying pretty hard. So I don't know what came out of there for statements, but I'm getting the feeling that people are maybe a little nervous.
I think there's a lot to be nervous about, especially if anybody is really going to pay attention to what Mr. Powell has been saying. I mean, he didn't say anything new. He's been saying same stuff he's been saying, and I don't know. I mean, he's hawkish. The whole Fed's hawkish. They want to get inflation down. They don't really care about some bank failures. They also don't really know what's going on with the bank failures. I think the guy must have said uncertain like 100 different times in the press conference, which the market doesn't like uncertainty. I don't know. Like you said, for a while it was trading higher on all this uncertainty and a rate hike. And it was just like, why is the market going up right now? It just, to me, I think something happens where like people, once they know that there's going to be a Fed meeting or a CPI release or whatever, for like several days, they just decide not to put any money into the market. And some of these people, some of these portfolio managers are managing big funds where their compliance officer has a mandate that says, hey, you've got to buy stocks. If you get money in, you got to buy stocks. You got to buy stocks. You got to buy stocks. But they can get away with like holding it for, a few days, a week, probably not quite 2 weeks. But what happens is I think a lot of these guys, as they take in new 401k, you know, deposits and just automatic savings that people have, they just kind of slow roll and they're like, well, I'll just wait and put it in after the Fed. And then they kind of are forced buyers, regardless of whether the Fed hikes or doesn't hike or how it reacts, or like they're gonna have to buy anyway. And
Hmm.
so they're just like pleading with their compliance officer, like, let me just wait till Wednesday. Let me just wait till Wednesday. Let me just wait till Wednesday. And the compliance officer is like, fine, but at 2:30 on Wednesday, you gotta have the money invested. And so they're like, boom, they hit the buy button with big size. And then, once that's over, the whole thing stops rallying and, closes on lows with big market on close imbalances and so on. So I don't know. That's my kind of theory. Like on these events, like you always get this weird pop, regardless of what the news is, even if it's bad news, even if it's good news, and then it takes a while to digest. So
Yep.
anyway, we'll get into the statement here in the next couple of slides, and then get into some charts and wrap up with some funny stuff. So let's get into it because I know you're trying to get out to start your vacation, man.
Sounds good. All right, Shane. So get into it and have fun. Oh, went too far. Here's our legal disclosure for all those interested. But more importantly, here's what I missed. So, Shane, I'm going to let you talk to this because all I know is the salad I ordered. I am not sure
I
of what the Fed said.
hope it was a Cobb salad. I like the Cobb salad.
Actually, this one, I think it was called the Sleeping Bear. That was pretty good.
Oh,
It's kind of a sweeter salad. But, you know,
perfect for the events of the day. Sleeping Bear. He was asleep until about 2:30 and he woke up with a vengeance.
it's funny because I didn't think about that till now. So, um,
So, all right, we'll just start with I put some highlights on here. Unfortunately, I didn't have time to like make them all come on at once. So the first one, you know, they're all out talking about how sound the banking system is. Well, we know how that worked out in 2008 when Paulson told us that the banking system is fundamentally sound over and over and over. In fact, if you can look closely, I don't know if you can see this. It says he insisted, and that seems like what's going on. We get, Yellen, everybody from Yellen to Powell to whoever they can put out there to say that the banking system is sound. They're lying to us and telling us it's sound. I can tell you it's not sound. And I'm not trying to cause a run on the bank. I'm not trying to say your deposits aren't safe, but I am here to tell you that if you don't know where your money is and you don't know what the balance sheet of your bank looks like, and if you have money there that's over and above the current FDIC minimums, I would seriously consider changing that if I were you. Um, Cause I think it's anything but sound, given what's happened to Silicon Valley Bank, New York Community, no, Signature Bank, New York. Um, we got First Republic that's in big trouble. You got Credit Suisse that, basically went to 50 cents or 50
And
point
yeah,
5 francs or whatever it got
I think
bought
it's
for.
important to note with Credit Suisse, they've been in trouble for quite a while.
Yeah,
Nothing too big there, but we'll get into it. But some
slow
banks like
rolling train
Silicon
wreck.
Valley, go look at your bank's balance sheet. Not a bad idea. But looking at Silicon Valley, I looked at it for the first time. We'll get into it, but
Yeah, we
just
have
at
that
first
in a later
glance,
slide, right?
yeah, we do. So it didn't look very good. I'm kind of confused how they didn't figure it out ahead of time.
I think they did. I think Wall Street knew. I think that's why the stock price looked like it did. I'm actually quite upset that we at Elevate didn't take advantage of that in some way, because it seems to be public knowledge that that bank was in really bad shape. And it should have occurred to me. Like I read one of their financial statements in recent quarters, and I actually shared the deck with a group of friends in a trading chat room that I'm in, and I never really thought to go short it. Like, I don't know why. I love short stocks. I should have shorted that stock. So, lesson learned. It's just a new thing to look out for going forward. Anyway, back to the Fed release here. They say highly attentive to what? Inflation risks, not to bank failures. So keep that in mind. They're still focused on bringing inflation down. They raised rates um, to 4.75 to 5% is now the range. So the top end of the range is at a full 5% for Fed funds, highest we've been at in a decade or so. And then they call for additional policy firming, which is a slight change of the language. But what that's supposed to mean is, look out for the potential for additional rate hikes. They want to keep rates sufficiently restrictive to return inflation to 2% over time. So they're not looking to cut rates. That's very clear. They haven't been looking to cut rates. Powell's been very clear that rate cuts are not on the table, not being discussed at all. They say very clearly future increases in the target range. So they are potentially not done raising rates. So we'll see if future increases happen or not. They kind of backed off. They didn't say they're certain about raising rates. I think they left the door open to hit the pause button in May when they meet. There's no meeting in April. So I think the option is there to hit the pause button and to be done with this rate hike cycle for now. But I don't think that means they're going to pivot to cutting rates. I don't see that happening anytime in 2023. You never know. If enough banks fail, they might change their mind. But as of right now, I think they're more focused on getting inflation down. Thankfully, I think that's a good idea. Um, and we'll get to the balance sheet later on as well. And I don't know, I think it's towards the end. But amazingly, they left this statement in here that says they're going to continue reducing their holdings of treasury securities and agency debt as described previously in its announced plans. Well, I was wondering, what in the heck? I don't know if y'all were paying attention, but last week the Fed balance sheet went up by $300 billion. It's now up for the year. After a couple weeks ago, I just told you that the Fed had already reduced its balance sheet by more than it did in all of 2022 and the first 2 months of this year. And so now their balance sheet increased again because they opened a window for banks to, basically sell assets to the Fed, and that's what the Fed did, was bought them. So I don't know. That's kind of a weird thing. I can't believe they didn't change the language at all. But anyway, they say they're strongly committed to returning inflation to 2%, which means, more likely to raise rates, certainly not likely to cut rates. And so that's where we are. And Powell mostly backed this up in his press conference after the fact. So Fed's still hawkish. Monetary policy continues to tighten despite bank failures happening at seemingly high rates. And so, yeah, I don't know. Not bullish, put it that way. I think we can put all this in the not bullish category.
I agree. And yeah, going into this, so we both kind of expected rates stay the same, but what you were not going to see was the Fed back off, because the big investors would see that as there is a hurricane coming, and sell everything you can. So not too surprised, but yeah, they're not going to let off. They are still going to be trying to slow this economy down, and that probably doesn't mean bullish stocks right now, but we'll see. We'll get into that one, but with
Definitely
that,
trying to thread the needle.
yep, we'll turn it over. So here's the big one. So Fed funds rate projections. Shane, you highlighted this one, but kind of just a little higher than we are right now, it looks like.
You know, I'll just tell you this. We could do a whole hour-long call on Powell's press conference and the Fed release. So I'm gonna have to shut up about it and just move on. Otherwise, we'll be here all day. But his, number one, I think this is dreamland. I think this whole sheet that you see in front of you, as far as change in GDP and the unemployment rate never going above 4.6%, and inflation, based on PCE going down. I think it's all crazy talk. And I think the only thing on here that's interesting is that they even say by the end of this year, 5.1%, or a range of 5.1 to 5.4% in the Fed funds rate by the end of the year. Remember, I just told you we're at 5.0. So this means higher rates, not lower rates. No rate cuts priced in here.
Mm-hmm.
And even, all the way out to 2024 and 2025, I mean, get some rate cuts maybe, out there and maybe out here, but nothing in 2023. Longer run, they want the Fed funds rate at 2.3, 2.5, with inflation at 2 to 2.2 all the way out in 2025. So I mean, they're not looking at the CPI. Well, I guess that's not CPI, that's PCE, so kind of not a fair comparison. But anyway, I just think it's interesting that, they're literally telling you we expect the Fed funds rate to be at 5.1% at the end of this year. Meanwhile, the market is pricing in rate cuts for the next, I don't know, couple of quarters between now and the end of the year. I think the market's crazy.
Yeah.
Go ahead.
Oh, I was gonna say I agree with you there. I think the market's crazy, and they're trying to fight the Fed, and the Fed's gonna push back. So
Yep. And I think this is a good chart to just kind of keep in here. I mean, back in March of '08, everything was going to be fine because Bear Stearns was bought by JP Morgan. It wasn't bailed out, kind of like Credit Suisse, right? Credit Suisse was bought by UBS. It wasn't bailed out. At least that's what they're saying. And everything's going to be fine. And they say that, Silicon Valley Bank wasn't bailed out by the FDIC, and Signature Bank New York wasn't bailed out. Everything's going to be fine, guys. Just buy stocks. Everything's going to be fine. Don't worry about it. And then we'll see what happens, you know, 3 to 6 months from now, what's going on in the market. But market, it doesn't have to look just like this. It doesn't mean we have to drop 40% or 50%, after some more bank failures. But it'd probably just be something else. Who knows? Who knows what else will cause the next major crash or meltdown, or if it will ever come. But what I think is important is that it can't. There's no reason that the market can't roll over and die from where it is now, even though market was down 20% last year or more if you look at the Nasdaq. So anybody who's ruling out the market going down 40% from here this year isn't paying attention to history. So I just want to keep this historical fact in front of everyone for a little while and kind of burn
yeah,
that into the memory.
yeah, I think, and the big one here too is just to show the stock market doesn't have to sync up perfectly with fundamentals, but Shane, and this one, so I'm long gold, so I can't go short the S&P, but I saw this and I was drooling to short this.
Yeah.
You got a perfect rejection right up into the 50 downtrend resistance line. And when you have a reversal like that on heavy volume, because you got the Fed meeting, so that's the catalyst that's out, right? Man, I want to short that.
Yeah, I shorted Qs instead because it's just a little bit closer to the higher end of the range. But I got a question for you, Kyle. The two like downward sloping purple trend lines there. Would you call that a megaphone in the CMT world?
So my buddies and I had this in our little trader chat, and I think it's a megaphone or broadening formation, or not. I think just megaphone, but I forget what the meaning on that one is. I know there's a big breakout that's coming. I just don't recall in what direction.
Like if it's a continuation or a reversal pattern?
Right.
Yeah, I have a feeling that one continues lower, at least to the low end of the range at this point, which is way down there at like 373. So I mean,
Hmm.
I don't know. Yeah, but I just didn't know if that would qualify as a megaphone, formation chart.
Yeah, and you know what I was looking at, just shorter term, is this flag right here. You had a narrowing wedge that was
Yeah.
going up and then it broke down. Those are usually just great setups to get short on. But yeah, when I saw it do that reversal and then got under some of my shorter time frames, so on the hourly, to me that was looking like a very nice short, which I have to admit, right down in here, I was bullish. I was starting to think, what would shock people, and that's if the market went higher. And seeing this, I'm with you. I think that this is that next target, 373, and this higher low that we put in, that one back in what was it, December? If we take that out, then I'm as bearish as you can get. But seeing that just short term, that's pretty good short signal, I think.
And a nice close below the 200 day, just brutal. I think that could get real ugly. So far for my mostly go sideways over the next couple of weeks and then drop to a fresh low, I'm pretty spot on with that call from a couple weeks ago.
Hmm.
I'm looking for that to play out.
Yep. So we'll see how that one plays out. But Shane, like you're saying, excuse me. So NASDAQ, man, last week we thought it was so bullish. And now you have went right back to was it kind of January highs, hit that, rejected, going back down. Looks to me like that's a great short setup. And, like you, I think if I had to pick between the two, that one has a little more risk reward with it.
Yeah, I mean, you just put your stop right there at the highs of the day today, just over that 313.74, which by the way, I mean, that's the year 2020 close. And you can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times in the past year easily that this has reacted to the 313.74 level.
Hmm.
So there's some serious stuff going on at that level. And I think that's a great, I don't do many of these trades. Normally I like to buy breakouts and sell breakdowns, but you look at that and I'm just like, man, I don't believe that this market deserves to go higher. I don't care how bullish this chart looked last week or yesterday. I mean, look how bullish it looked just yesterday. If we take today's candle out, it looked like it was just going to keep marching higher. But I just don't believe it. I don't see any fundamental reason why that should happen. And so getting to short something at the top end of the risk range right there seems like a good idea right now. So it's not my normal fare at all. I normally don't take that trade, but I shorted a couple times intraday today, made chump change because I was a sissy and didn't hold it long enough, and then re-shorted it into the close today when everybody else was selling. So I'm hoping we make a big gap lower tomorrow and just kind of continue down on the Nasdaq.
Yep. So we'll see how it plays out. But Um, Shane, your
Yeah.
line count restarts
So
now, right? Is that how that works?
it doesn't restart now. So this is again just looking at the 200-day moving average, which is this blue line. So this is the S&P 500. This is the price chart of the S&P 500, but the blue line is just the 200-day moving average, which we're highlighting. And one of the things I've been looking at for an indication that we might potentially be in a new bull market was for the blue line to start trending higher like that. Um, Unfortunately, it didn't. Right now, we can see that the blue line is trending lower, right? Right here, it's actually trending lower, and it put in this was the prior low of the 200-day moving average, and this was the most recent high. So ever since Thursday, March 9th, the S&P 500 200-day moving average has been trending lower, which signals to me that we are still in the throes of a nasty bear market. So
Yep.
look for, the 200-day moving average is the trend. That's it. When it's going down, the trend is down. If it were going up, the trend is up. That is the long-term trend. So that's what we're looking at to give us an indicator, an early indicator of when we're back in a bull market, when we should start buying dips. Until that 200-day moving average starts moving higher, the trend is not up, and you don't want to be buying dips in a bear market, I promise. So that's kind of where we are there.
Pretty accurate. And same thing here with the Qs.
Yep, same deal
So
with the Qs. So it's been going down since Wednesday the 15th. So it put in a high a little bit after the SPY and but has been trending down since then. So yeah, it's not going down as much as the SPY, but it certainly isn't going up. So we need to see when it puts in its next low, and then we're looking for 21 consecutive days of increasing 200-day moving average. That's what I'm looking for as an indicator that we're back in a bull market. And there's nothing magic about 21 days, by the way. It's just a number that I think represents a reasonable amount of time. It's basically, 3 weeks.
yep.
That's it.
And that is just for anyone listening, that is about the number of actual trade days in a month. So
Yep.
that's one thing you could say. But man, this one, Shane, 10-year, the volatility's been just absurd lately, but it looks like the yield's back down, which is good because you think, well, they're not fighting inflation like that, but why is all the money running to fixed income known as the safe haven?
Yeah, well, a few bank failures will send people looking for treasuries, right? They pull their money out of the checking account and they look for treasuries to go buy. I think there's also something to, and I don't know, like I haven't dug into it very much, but I don't know how many 10-year treasury bonds like got moved off of the balance sheets of banks and then sold to the Fed. And I don't know what sort of impact, like there was a $300 billion bump in the Fed's balance sheet. I don't know how much of that was them buying 10-year bonds. But this
Hmm.
to me indicates that somebody's buying a big, big piece of 10-year bonds. So I don't know how much that directly has to do with it, but certainly indirectly it has made some waves.
Yep. So we'll be watching that one, but that the volatility alone for me in the fixed income market like that is pretty concerning.
Yeah. Yep. Agreed.
And then here's the dollar. We were bullish before. Now it's breaking down, it looks like, and we said that could be positive for stocks, but I don't think that in the context of everything, that's the case this time. I think you're starting to just see the financial system, show some cracks. What are your
Yep.
thoughts?
Yeah, I think that's true. I'm surprised that the dollar didn't rally today on the Fed hiking rates. But the deal is that I think the ECB hiked rates by 50 basis points and we only hiked by 25. So as long as the ECB is hiking faster at a faster pace than us, that's going to cause people to sell dollars and buy euros. So I think there's a part of that to it. Is that just the ECB is hiking faster than we are at this point because we were hiking faster than them for like all of last year, basically.
Hmm.
Um, so I think there's some of that in there, but I also just think like technically, I remember saying like, hey, this thing's done. Like it's done going up for a while. It needs to go sideways. It needs to have the MACD kind of turn red and then start going back up again. So I don't think it's a big deal as long as it kind of holds this 100 101 area. I think it's just building for another move higher. I would rather have a strong dollar if I were fighting inflation. The weaker the dollar, the higher the prices go. And so I don't think this is what the Fed really wants to see. I think this might cause them to hike rates, even further in the future. Although my base case is I kind of expect that they're done right now and going to pause next time. So yep, just something to keep an eye on. Looks like it's trading mostly on technicals. But then, again, the only fundamental I can think of having a big impact is the ECB hiking faster than the Fed at this point.
Yep. And then, so here's oil, and Shane, I got long oil right down in here, so around 65 or so, but this is not looking for a long-term bounce, just an oversold bounce. I think it's kind of over right here, especially just with the Fed announcement today. I thought that might be the spike that gets it to go higher, and I think it actually closed just under 70.
Yeah, it may have. I don't know. I think yeah, 7001 is where they have it pegged to trading view. So I don't know. Yeah, I don't know. I don't know what I think here. I kind of think that it shot down as far as I sort of expect it to shoot down, like even going back to all the way over here in late what's that? I guess 2021.
Hmm.
I think we're right back to around those levels, and I'm hoping that the United States, Team USA, hopefully bought a whole bunch of oil for the strategic petroleum reserve down there under 70, like they said they were going to,
Yep.
and if that's the case, then it's not probably going to go much lower than 64. So hopefully it'll just build a base around here and then maybe get ready for another jump higher. But just like it overshot right here and then fell down, just like I expected it to do. Um, Now I kind of think it's gonna, like, that was it. Like usually there's just one kind of puke. Like that looks like a pretty good puke. It's been working its way lower and working its way lower for like, a year, and then just kind of dumped to a fresh low right there. And so I wouldn't be surprised if it doesn't go much lower than 64, in the near term, and just kind of grinds its way sideways and then maybe starts going back up again. But yep,
Yep.
I'm glad I'm not trading it, tell you that much.
Yeah. And I agree there. I think this is one where you kind of get that fake out where it could break down hard and bounce. And, I caught a piece of that. But right now, we'll see. I think if it consolidates here a little bit, then it probably could go higher. But it's kind of down in that area right now where I think they should start reloading the SPR, but we'll see. And then Bitcoin. So Shane, you showed me this before, and then it's been all over Twitter. Bitcoin back to the moon. It is pretty
Moonshots.
bullish,
Oh
but
yeah.
has it changed since we last talked, or just maybe we're taking a break here and then we'll keep working higher?
No, I mean, yeah, it's gone up. I mean, geez, in the last week, how much has it gone up? I don't know. Let me just look real quick.
What, that's about 40%.
Yeah, well, no, just in the past, what, 6 bars or something, we're up 15% more on, like, up
Hmm.
from 24,262 to call it 28,500 is where it stopped. And that 28,500 level is a really old level. Like, there's a lot of action going on at that level, going all the way back to basically January of 2021 is when it first broke that 28,500 level, and it's acted as support and resistance a number of times since then. So I expect it to kind of, I've been long Bitcoin, as I told you guys. I was buying it back down here and down here at the 200 day and added some more right here. So I've got most of my Coinbase account long Bitcoin, and I was expecting it to kind of stop right here at this 28,500 level. Um, but I think I'm just gonna hold on because I don't know how much it's really gonna pull back. I'll put some stops in, maybe around 25 or something like that. But as long as it holds up, I think sideways is the play for a while, and then just builds up some momentum for a fresh move higher. The next level after that is like 32,700, and I mean, as we all know, and you can see in this chart, when Bitcoin wants to run, it can run. And to be doing this against the backdrops of banks failing left and right, I think is kind of a big deal.
Yep.
Um, I'm not going to go out and say that Bitcoin is going to replace cash in the bank anytime soon because it's still extremely volatile. But I mean, Bitcoin hasn't failed. There's nobody closed up shop on Bitcoin. You could trade it on Sunday. You could trade it on Saturday. You could trade it at midnight. You could send it to your friend at midnight. You don't need a bank to be open. You don't need somebody to maintain and manage a balance sheet and lend appropriately. Like you don't need any of that, right? And so that's like the primary case for Bitcoin. And I think it's doing what it's supposed to do in an environment like this. And so I'm pretty optimistic, and it's easy to be optimistic when you're up a bunch. And so, I'm not going to let a winner turn into a loser or anything, but you know, I was expecting 28,500 to be some strong resistance, but I just really don't want to sell it.
Yeah. And I tend to agree with you on that one. Swings like that are always tough to manage. You can have a trailing stop. That's a decent way to do it. But it gets hard up there because you start selling pieces of it and you just don't know if it's really going to come down from there.
Yeah.
So, and
I'm in for the
then,
long run anyway, so whatever. It's not a lot of money.
yeah. And now we don't need to beat this one too hard, but, just yield curve inversion, less inverted now. But, we've said it before, the inversion already happened and that usually precedes the recession. So,
Yeah.
no, not looking too good there.
No, the key to remember is that when it uninverts, it doesn't mean the day is saved. It just means we're closer to the recession starting. So,
Hmm. And then here is one, gosh, this Shane, I'll let you be the doom and gloomer on this one. I want to stay positive, but
yeah.
a lot of
Well,
liquidity pumping into the market.
like like it's crazy how much money just got pumped into the market over the past, well, I guess a week ago, right? Like I'm kind of dumbfounded by how much money it really was, because we know that this happened during the financial crisis. We know that, the bailouts happened and the Fed did its first ever QE program. And now they they did more QE last week than they did during any week during the financial crisis, and then they have the audacity to call it not QE. It's like, so why are you doing so much of it if it's not quantitatively easing monetary conditions?
Hmm.
Like all that's going to do is reaccelerate inflation and cause you to have to raise rate. Like these people have no idea what's going on. We're a giant experiment, and I just think it's amazing how much liquidity, you know, like that. It's not even close. Like they just blew right through um history. I mean, to me, it's just like way more than COVID. Look at how much they
Yeah.
did during COVID, And so I can't believe how much, how many assets they bought from these troubled banks, and they opened the discount window. The discount window, by the way, just like I'll try and do this really quick. The discount window is a place where banks that are not in trouble can go and they can pledge long-term assets to the Fed. They say, here's the long-term bond. It's currently trading at $800 in market price, and they can borrow that $800 from the Federal Reserve. So the Fed takes the bond and puts it on their balance sheet. The Fed gives that bank cash to go operate its business. And there are term limits and there are costs and all that. I'm not going to get carried away with that. The point is, the big, big, big point is that the bank bought security, whatever the bond is. Let's say it's a 10-year treasury bond. They bought the 10-year treasury bond at par. So it's supposed to be worth $1,000. But they're coming to the Fed, and because rates have gone up from where the bank bought that treasury bond at $1,000, it only trades for, say, $800 in the market. So if the bank had to sell that asset to finance their operations or to meet investor, withdrawal requests, they would only get 80 cents on the dollar for the asset on their balance sheet. If they go to the Fed, what they can do is they can get that same 80 cents on the dollar, but keep a hold of their asset for the future so that they can liquidate it at par when it matures in 10 years. And so that's the whole idea for the discount window. What they did last week was this whole new facility called the BTFD or something. I can't remember the acronym. It's like it's not BTFD because that's by the F and dip. But it's pretty similar to that. It's pretty close to that. And here's the big deal is that instead of the Fed lending what the market value of the security is, the Fed will lend you 100% of the par value of the security for a full year, and they will do it for banks that aren't even in trouble. So like even if you don't need the money, if you're a bank and you have assets sitting on your balance sheet that, you bought at 1,000 and now they're only worth $500, you can go to the Fed and get the full $1,000 for a whole year. It's just like free money. And this is how many banks effectively took advantage of that situation in 1 week. I have no idea how many are taking advantage of it this week. That number might be out. It comes out on Thursdays at like 4:30. So I'll have to go look and see what the Fed balance sheet increased by this week. I wonder if that's on the St. Louis Fed yet. But anyway, the point is like this is a straight up bailout, and it like you don't do stuff like that when the banking system is sound.
Hmm.
You know what I mean? If the banking system were sound, you would not see that giant orange spike right there. Like that's absolute madness. So anyway, I not to get too carried away with all that, but that's what's going on behind the scenes. I don't. Hopefully that helps. I don't. Did that make sense, Kyle?
It does. So, yeah, thanks for the explanation. And it doesn't mean the world is ending, but what that means is something underlying probably isn't functioning quite right. And the Fed's trying to make sure things run smoothly by, providing liquidity. So, and Shane, here it is. Look at that big old bump in the balance sheet. So right back to where we started the year and above that.
I
So,
mean, it's not like we didn't notice. Like we noticed, like, hey, this whole amount right here is down just as much as the whole year last year, and we called it out, and then what? A couple of days later, it's like zoom. way up. Like that is just crazy. Like they took us all the way back to what, November of last year. They undid all the quantitative tightening that they've done since November. Just poof in a week, gone. Like
Yep.
and then they're gonna tell you that it's not inflationary. Like, what do you mean it's not inflationary? What did you buy those assets with? Hershey bars? Or did you put dollars into the economy? Because more dollars into the economy means inflation, you know? So anyway, yeah, I just can't. I couldn't believe it when I saw this last Thursday. It just like it totally blew my mind. I went for a walk with my wife, and she's like, "What's wrong?" I was like, I just can't believe how crazy these people are.
Yeah, I mean
And
that's
you know, you knew they were going to spin it too and say, "Well, it's a short-term thing. It's not quantitative easing," and that's exactly what Powell said today in his press conference, like verbatim. He was like, "Oh, it's temporary. It's not inflationary," and that was it. Only one question out of an hour worth of questions. Only one question on how are you going to say that you're committed to reducing the size of the balance sheet, yet in 1 week you increase the size of the balance sheet by more than you did during any week during the financial crisis. That's
hmm
bananas.
yeah, it's a big one. So and it looks like I bumped the cursor here and flipped to the next slide, but if you want to talk to this.
Yeah, you know, that's just a quick, you know, the normally markets bottom all at the same time. You know, whether it's 1990 or 2022, 2002, 2009 or 2020. Um, Markets all usually tend to bottom around the same time, around the same time. So the exact dates don't matter. But there's usually capitulation in all of the major indexes, all right around the same time, and that normally signals a major bottom in markets. Of course, you can't see it until after the fact, right? But that's looking back at history. Normally, you see that all happen at the same time. And now you're seeing the Russell so far put it in its bottom way back in June of 2022. The Nasdaq didn't put in its bottom until late December 2023, and if it holds up, the S&P 500 bottomed in about October. So there's a lot of space in between all those current bottoms. What's more likely is that each one of these indexes will put in a new bottom right around the same time before the bottoms are all finally in. So no guarantee on that, but I just thought that was an interesting look at the indexes all side by side, and you know, compared to history. History would say that we probably haven't actually seen the bear market bottoms yet.
Yep, I think that's a good point. So thanks for bringing that in. And then Shane, I wanted to bring this in. This is the balance sheet from Silicon Valley Bank, and I didn't go through, do all the ratios, all that, but I just want to look at it and understand, well, what did that look like? And what people need to understand is banks make money by they take in deposits. That's the first funding source. But if they don't pay an interest rate and they don't have a lockup on time, as you know, there could be a run on the deposits. That's what happened. Your next source is you have a CD. CD, you sign up for that and you commit your money for, say, 6 months, get paid a little bit. What's nice if you're a bank is you pay a little more for your funding source, but it's committed for a longer period of time. And then, you can go into some other areas, wealth management division. They can use those assets too. But when I was looking at Silicon Valley Bank, so first off, let's just go to that funding source like I was talking about. So they had 80, was it billion in non-interest bearing and only 92 in interest bearing. And what's alarming about that is they've got a 50-50 split between the two. Furthermore, if you look at their held to maturity assets, which I think those are usually in the bank investment portfolio, but held to maturity, those are usually longer duration and in a rising rate environment can get blown up, lose a lot of value. And that is as much as half of their entire funding source on the short term. So I look at that and it's like, well, of course they had a bank run. I mean, they hardly had any of the, funding locked up. So Shane, I don't know if you had any points on that, but that was my takeaway. They're sitting there with all these held to maturity securities, and they don't have any, sticky funding source really.
No, I think it's obnoxious that, you know, they knew this and they knew like they had an abnormal amount of deposits that were way over and above the FDIC limit too, which are ripe for deposit flight. Like when money's going to leave, that's the first money that's going to leave. When anybody smells any remote sense of trouble, that's the first dollars to get pulled out. And they had an abnormal amount of dollars on deposit that were over and above the FDIC $250,000 limit. So what you should do if you're running that bank is not buy, long-term assets that are held to maturity, because you should know better. Like that's just a risky way to run a business, especially a business that's focused heavily on one specific geographic area, Silicon Valley, California. And in Silicon Valley, California, you're very hyper focused on technology and startups and venture capital. It's all geographically concentrated, it is sector concentrated, and these people know how to use technology to move money around. Like, how hard is it to pull money out of a bank and move it to Charles Schwab or move it to JP Morgan or move it to, anywhere else that you're more confident in, or buy some treasuries with it. So I think that's probably why the 10-year yield dropped so much too, is like people saw that and they're like, well, screw it. I'll just take my money out of the bank and go buy some 10-year bonds,
Hmm.
and like I don't know how many people are converting checking accounts into 10-year bonds though. That's why I don't see the direct correlation. But yeah, to me, like this whole thing is just irresponsibly managed all around. From the people who had that much money on deposit at this bank, they should have been looking at the balance sheet of the bank to know what the situation was before they had that much money there. The people running the bank should have known how exposed they were to deposit flight and not bought so many held to maturity assets. And the regulators should have been very clear that, like, wow, there's a risk here. Like I was telling
Yep.
Kyle earlier today, like the only thing surprising to me is that anyone is surprised about this. Like it is
Yeah.
insane. This should not come as a surprise.
And Shane, look at this. So 2021's in the right column. So their non-interest bearing deposits went from 125 billion to 80
Yeah.
over a
Almost cut in
year.
half. Almost cut in
Yeah.
half.
And then, on those held to maturity securities, that's half of their total assets. I mean, wow. If things
That's
worked out, great. But if they don't, they're so leveraged on that. It's not going to go well. And it didn't.
and it's just like they said in The Big Short, it's like they weren't stupid, they just didn't care. They knew that the government would come and bail this out. Like I don't think they were stupid. I think they literally didn't care, which is why so
Mhm.
many insider loans got made at that company in the year leading up to this. It's like they knew. They
Yeah.
knew everything would get bailed out, just like it always does. That's why bailing companies out, regardless of, how much you're going to help save the little guy, it just creates too much moral hazard to where the guys running this bank, they knew how to take advantage, is my guess.
Yep. And then for a comparison, I brought up US Bank. This is a good one. Just, kind of a boring, safe bank. And look at this. Their held to maturity portfolio was less, even though they are much larger.
Yep.
But look at this. It's only what, 1/7 of their entire
Of their
asset
total.
base.
Yeah. Instead of half.
Yeah. And
That's
then
crazy.
if you look at the non-interest bearing, it's was it 1/5 of their total funding source. The rest is in interest bearing deposits. So when you look at this and then you look at Silicon Valley Bank, it's like, were they running a hedge fund or a bank?
Right.
So I think, I'm not the one that knows all the inner workings, what happened, but just looking at the balance sheets between the two, it's pretty obvious
But
that Silicon was definitely just leveraged and they
on
had
uh,
funding that was not sticky.
sorry, on the interest bearing, is that you're looking at, like you're calling interest bearing, those are the CDs that have a maturity date, and the non-interest bearing are like checking accounts. Is that where you see that?
Exactly. Yep.
Yeah, okay. Cool.
And the big thing there, interest bearing, it doesn't mean it's because when you buy a CD, if it's 6 months, you can take it out a few months in, but you get charged a penalty. So it's
Yeah,
pretty sticky. So the
right.
deposit runoff assumption is that far less will run off in a rising rate environment.
Right.
So, and then just glancing this one here, but 30-year mortgage, ticking up a little bit, but coming down slightly. You
Yeah,
can see
down for
it
the
just a
week last
little
week.
bit.
This is as of last week because mortgage rates will come out again tomorrow. I forgot it's not Thursday, so I was looking for the balance sheet update. It doesn't come out until tomorrow at 4:30, so we won't have that until tomorrow. We'll see how much did the balance sheet increase this week or last week, tomorrow. And I I don't know what to expect. Like I think it's a total crapshoot. You got to figure it increased by some amount though, because when you're willing to give a bank, 100 cents on the dollar for something that only trades at 50 cents on the dollar, I mean, you'd be crazy not to take advantage of that if you're a bank. Your shareholders would probably be upset with you. So
Yep.
I bet you the balance sheet goes up again, which is going to be inflationary and maybe leads to even more rate cuts to help offset that, or sorry, rate hikes to help offset that. Pretty
Yep.
crazy. Yeah, next we got a chart, the trading view chart of mortgage rates. So this is the same little rate, but it just goes back further in time. It just kind of shows you how far into breakout territory we are. And Kyle and I have been talking about these areas, geez, for over a year now. So if we break through the 7.24 area, look out, because 8.64 is on tap after that. I have a feeling we're going to hang around the 7% area for a while though, because the market doesn't. I don't know if you saw this, but last month we had the first month where house prices were down year over year since 2011. So I think it was 11, yeah, 11, 12 years. First time in 12 years, I think is what it was, that house prices came down across the board in the United States of America. And that's simply because interest rates are so high. So no surprise, we've been talking about this for a long time. And the longer rates stay up here, the more likely that is to continue.
Yep. So I agree with you though. I think it's going to take a little time to go up. It's just a big, machine to move, the entire mortgage industry. So it'll take a little bit, probably consolidate some, but with
That's
that,
it. On to the fun stuff.
the fun stuff. Shane, my favorite, you've found this one, but Green Guts Bank fails due to unsustainable business model of hoarding customers' gold in a giant cavern protected by a friggin' dragon.
Yeah,
Pretty good.
that was a funny one. Those guys they're hilarious. And then of course on the left, hopefully none of our clients are happy for this reason. But I remember when I remember back in 2008, 2009 when this stuff was going on, and I was like, huh, it's a good thing I don't have any money to lose because I'd probably be getting killed. So anyway, that fiasco sent me all the way to Costa Rica with a backpack for 3 months. So anyway, yeah, funny stuff out there from the B as always. Happy to share with you guys. So I think that's
Yep,
it for this week, right?
it is. So
Cool.
thanks again for joining me this week, and we'll see. But I'm curious. The next few days, I think we could push the market lower and see how it all shakes out. But
What are you gonna be doing? You gonna have access to a buy and a sell button, or are you checking out for a couple days?
I'm mostly going to be checking out. So
Yeah.
take a little time, be good.
What do? You let it ride, or do you like try to go out of town with no positions on at all?
So I try to swing trade more, so I'll just have my stops in, let it go.
Yeah.
Like I said, I'm long gold right now, and that trend's working for you. And the longer a trend works for you, the more time you can just kind of sit and let it do its thing.
Cool. All right, man. Well, happy birthday and have a great time.
Thanks. You too. See
See
ya.
ya.